Dave Ramsey, Mr.
Better
Better Than I Deserve. This guy did it the hard way. He went broke, learnt his lessons. He turned a radio show talking about finance into an absolute YouTube sensation. He and his team have helped more people than I could ever dream of, and Dave's had millions of views, millions of subscribers, and probably has millions in assets. He definitely does. So with that in mind, why on earth would I be suggesting that Dave is wrong when it comes to retirement? Well, let's take a look at this.
So I'm debt free. I have about $3 million, and I'm curious if that's enough to comfortably retire.
Well, it should be. It's a lot of money. Well done.
Thank you.
How old are you?
58.
Okay. So if it were me, I would have put that in good growth stock mutual funds, making 11 or 12% and lived off of about 10 or less, which means I would have somewhere around $250,000, $300,000 a year to live on. I think I could struggle through. And the money would never, and the principal would never deplete substantially during that time, and I could do that in perpetuation.
This viewpoint about getting double-digit returns on good growth stock mutual funds and then taking 8 to 10% withdrawals, well, at best it's unclear. At worst, it's dangerous. And Dave doubled down on this viewpoint in a dispute quite publicly with one of his own co-creators under the Ramsey brand. George was actually making some pretty reasonable points about sustainable withdrawal rates.
This is just honest math. Literally, there's a site called honestmath.com, and they ran 10,000 different financial simulations to get this chart and show you these numbers. All right, so let's look at this chart. On the left side, we see years in retirement. On the top, we see the withdrawal rate. And as you can see, if you have a 30-year retirement with a 4% withdrawal rate, you're going to have 3% of that account balance remaining 30 years later. But when we move on to the 3% withdrawal rate, you will see that even 35 years into retirement, if you withdraw 3% a year, you'll still be left with 90% of the account balance. That's pretty impressive. And you can...
Okay, I'm a little confused because I don't know what the hell George is doing a 3% withdrawal rate, because that's absolutely wrong. I'm going to have to find out where that video is and get it taken down. Or I hope you misunderstood. I hope we didn't put out trash like that. I mean, if you're making 12 in good mutual funds and the S&P is averaged 11.8, and if inflation for the last 80 years has averaged 4%, if you make 12 and you need to leave 4% in there for inflation raises, that leaves you 8. So I'm perfectly comfortable drawing 8.
A lot of the studies I found showed...
Well, there's a lot of studies that are stupid in this space. So, it's just wrong. Listen, man, the math I just gave you is the math. If you're making 12% and inflation is 4, and you leave 4 in there, so your nest egg grows by 4, it's simple. But there's all these goobers out there who have always put this 4% crap in the market, and I'm just irate right now that we have joined the stupidity.
Why is it that stupid, though? Like,
it's too low.
Yeah.
You know, because stupid people put out low withdrawal rates. Like you,
but
listen,
if
you think you can only pull off 4% off of investments making 12, where the flip is the other 8% going?
When it comes to sustainable withdrawal rates, I think Dave is wrong here. I think we should look closer at the figures, look at some scenarios where that advice would have caused you big problems, and hopefully we can get more clarity on what you can take from your investments without the fear of running out of money. In many of the discussions that Dave has with callers to his show, he'll quote this 8 to 10% withdrawal figure. Now, it sounds simple when he says it. You get 11-12% growth on your investments, you draw 8 to 10% of that as withdrawals, and the remaining 2 or 3% is there to cover inflation, the fact that you'll have to draw more next year to keep up with the rising cost of things. But this ignores 2 key points. Firstly, there's the assumption that you will get 12% returns on your investments, and then secondly, there's the assumption that it doesn't really matter that markets are volatile, but it does. And the sequence of your returns is incredibly important. So firstly, to this 12% annual return figure, I'm sure some of you are thinking, no chance. Well, it's actually not that unreasonable to assume that you may get an average annual 12% return if you hold a basket of the world's companies over a long time frame. If we look at the data on the return from global equities, say, over a long stretch, it does actually average around 12% a year. Of course, you will have had to put up with some major ups and downs, but if you were just invested in US equities, say the S&P 500, you would have, over recent years, been above that 12% annual return if you'd have stuck with that. Regardless of the data, the evidence, we still don't know what the next 100 years will look like, whether that looks like the last 100, and certainly not what the next few decades will even look like. What we do know is that most investors do not collect this market return. Even if they do have an 100% equity fund, an S&P fund, for example, the average retail investor does not achieve that level of market return due to their behaviour. More importantly, because many investors know that they won't sit through a 30, 40, maybe even 50% temporary decline in the value of their pot, they will choose purposefully to not invest in solely equities and instead introduce other assets to dampen the volatility, things like bonds, perhaps commercial property or alternatives. They do this knowingly, accepting that they won't get the highest rates of return, but it'll allow them to have a more comfortable ride and something that they're more likely to stick with. You have to accept that risk and return go hand in hand, and if you're not going to go at the far end, that 100% equity portfolio, you shouldn't be expecting to get the 12% annual returns that we're talking about here. Dave always refers to this 12% coming from great growth stock mutual funds. He's spoken a little bit about his own structure and how he does that for his money, but usually he's referring callers to his team of financial advisors. They're called Smart Investor Pros. And you might be cynical and say, well, this is just a way for Dave to introduce people to a paid-for service where they can recommend actively managed funds. Personally, I'd rather index, I'd rather control what I can control and get the return due from the market I'm investing in. But all of that said, I do understand where Dave is getting these broad 10 to 12% figures from. That is the average long-term return from the market. But this brings us to the second point, the most important one when you're thinking about withdrawing money from investments. Even if you are willing to have 100% invested in shares and ride the ups and downs that come with the market, what if you are taking money out of the fund at that time? What if you have a year, 2, maybe even 3 years, where there is no return from your investments? Perhaps it even falls significantly in value. Once it's fallen and you start taking money from that, you need to sell more of the shares, more of the units in your fund in order to fund that income, and it leaves less then in the fund to rebound when markets come back. This is known as sequence of return risk, and it is incredibly important once you start drawing money from a fund. If you're accumulating, if you're building your wealth, you shouldn't really concern yourselves with the temporary declines in the market. In fact, you should be welcoming those, and it's because you can get more units, more shares during a market downturn, and then it goes on to new highs. But once you are reliant upon your fund to provide an income, you need to consider whether there's been a good year for returns and whether you can continue with your withdrawals. To help illustrate my point here, let's assume I've retired. I've got £300,000 in an invested pot, and I'm going to take Dave's advice and withdraw 10% a year. Now, to do this, I'll explore it in 2 ways. I'll take 10% of the pot value each month. So this will be a fluctuating income. If the pot value goes up, I'll take 10% of that. And if it falls, again, I'll take 10%, but of course it will be a lower income amount that I actually withdraw. And then secondly, I'll take a fixed 10% withdrawal, so £2,500 a month, regularly each month as we go along. Although US shares have enjoyed some really stellar returns in recent years, what if you'd retired, say, in 2001? Right before the dot-com bubble bursts, you've invested in the S&P 500 and you use these withdrawal methods that we've spoken about. Well, if you take the fluctuating 10% withdrawal a month type strategy, then today, as we stand in 2024, your 300k would only be about £170,000 now, and the income amount that you'd be able to take from that as a 10% is now only £1,400 a month. And at its worst point during the 2008 dip, you'd have been down to about £750 a month. Worse yet, if you'd have stuck with that blind £2,500 a month fixed withdrawal, then after the dip in 2001, by the time you get to the 2008 market crash, you actually run out of money. Now, by no means am I saying that you shouldn't have some element of a basket of shares within your retirement portfolio. I've clearly picked a bad point for retirement there, but most of the time, the market is progressing, the market is trending upwards. And if we look at, say, the Vanguard Life Strategy range, a popular range of funds in the UK that launched in 2011, if you'd have invested your 300k in each of these fund options from 20% equity right through to 100% equity, then as we stand now in 2024, it's probably not surprising to see that the 100% equity fund comes out on top. And if we look at withdrawing money from this fund range over that same time frame, if we use, say, a more reasonable withdrawal rate of around 4%, then if we look at either the fixed scenario or that monthly fluctuating income scenario, both of those end up with a 100% equity fund coming out on top. I also looked at some longer term data going back to the 90s. I used the Investment Association sector averages, so these are kind of average benchmarks for funds that typically have 90 to 100% in shares in a global, and then down to 60, 40, 20% in shares. And I also used the Bank of England base rate as a bit of a guideline for cash. And then with our 300k pot, if we take that 4% withdrawal in both the fixed format and the varying format, the equity investor with 90 to 100% in shares, they do go through some pain points, some pretty big drawdowns in the value of their investments, but in the longer run, they've won out in terms of the amounts in their pot. And for the investor that's varying their income each month, they've gone from £2,500 a month in withdrawals to now being able to take over £3,500 a month. I also had a quick look back at the 2008 market crash, and again using these IA sectors, if you'd retired right before one of the worst times possibly that you could have done in recent years, and then started taking these 4% withdrawal rates, actually, again, even though there's a major drawdown at the outset, you do actually end up better off having remained in equities as long as you stayed that course. So what conclusions can we draw? What takeaways can we get from what we've looked at? Well, I would say that equities, a basket of shares, can help in the probability of you sustaining your invested pot, perhaps growing your income over time. But that said, we have to accept that sequence risk is real. We cannot know in advance whether we're retiring to another 2001 style market crash. It'll be for different reasons, but if you have a prolonged period of lower or negative returns, this might do irreparable damage to your investments and mean that you either have to drop your income, or if you don't, you may run out of money during your lifetime. The higher your withdrawal rate, the more adaptable you will need to be. If you're going to set off on a course of taking 10% withdrawal rates, you really can't do this blindly. You will need to look at the returns you've got and then be adaptive, be adjustable, take a lower level of income if the markets don't go in your favour. Now, if you cannot do that, if you cannot accept any lower income, then you need to go with a more sustainable withdrawal rate. You perhaps need a more stable investment plan. And there's nothing wrong with this, you just need to find the right balance to suit you and your circumstances. Sustainable withdrawal rates over a 30-year retirement period probably fall closer to the 4% range. And yes, shares can potentially give a bit more probability of you being able to take more. But if you're not going to be adaptable, they can do more harm than good. So I'm sorry, Mr. Ramsey, but I cannot agree that 8 to 10% withdrawal rates are some kind of no-brainer that makes sense for the majority of people. The math just ain't mathing. Thank you for watching. My name's Andrew. I am a chartered financial planner based in the UK. Let me know in the comments your take on Dave Ramsey. Are you a fan of the content? What do you think about sustainable withdrawal rates? And if you're new to the channel, tap the subscribe button for plenty more to come. If you wouldn't mind pushing that like button, as it does help with the old algorithm. And I'll see you all for the next video.